Hello Mindsetters, and welcome to a grade 11 Learn Extra lesson on partnerships, financial statements, in other words, the income statement and the balance sheet. This is a continuation from a previous lesson which was also on the income statements and the balance sheet, and it's a very, very important skill that you need to learn when you are studying your accounting to know how to complete an income statement and to know how to complete a balance sheet, because these two normally go hand in hand and make up 80 to 100 marks of a question in the final exam. So we're going to focus specifically on preparing an income statement for a partnership and also in preparing a balance sheet for a partnership, but with a specific emphasis on the notes on fixed assets, which is your note 3, as well as your current account note, which is your note 8. You need to know the format of these notes very, very well, because it's essential to know what goes in these notes and essential to know how to record all of the different transactions that you may be required to record. And what you need to bear in mind is that this is your section where you're going to be recording your end of year adjustments. In other words, adjusting the figures in the income statements and in the balance sheet so that they provide a fair reflection of what you've earned or what your financial position is in a particular year. Just to quickly recap for you, we use an income statement to calculate our profits. So to calculate our profits, what we do is we take all of our incomes and we subtract all of our expenses. So those are the two main items that go into the income statement. There's a section for your incomes, there's a section for your expenses. You subtract the one from the other, and that gives you your profit for the period. A balance sheet is very similar to an income statement, except instead of calculating your profits, what it does is it shows you your financial position. So you can think of it this way: a balance sheet is really a diagrammatical representation of your assets, your owner's equity, and your liabilities. And you should remember from grade 10, your accounting equation, that your assets must always equal your owner's equity and liabilities. Those items appear in your balance sheet. Now, your balance sheet you would have done in grade 10, and you would have done it in detail, so you should know it quite well, except for the fact that there are two new notes that you would have learned in grade 11. The first one is the note on fixed assets, and the second one is the note on the current accounts. So you need to be able to do these two notes because they're new. And in today's show, we are going to focus specifically on exam revision, on answering a proper exam question based on these two notes and based on the different types of adjustments that we have. So let's have a look at our first example question. This is a question from November 2013 from the Eastern Cape paper. And we're looking at our fixed assets and financial statements. So what they've given us is an income statement that was prepared by a newly appointed bookkeeper. Very often the questions have got newly appointed or inexperienced bookkeepers that have prepared financial statements, and you as the grade 11 expert in accounting need to come and fix up this income statement by fixing the errors that the inexperienced bookkeeper has made. So they've told you that you've inspected the statement. Upon inspection of the statement, it was discovered that there were many errors. So what they're asking you to do is prepare the correct income statement, and you're going to need to fix the errors that this inexperienced bookkeeper has made. So the very first question deals with asset disposal. We have to prepare the asset disposal account in the general ledger. So I hope you know how to do this. You would have done it before in your section on fixed assets, but this can come up anywhere. It can come up in the partnership financial statements question. And hand in hand with that goes the skill of preparing the notes to the balance sheet of tangible assets, which is your note 3 on fixed assets, and also preparing your notes on trade and other receivables, which you should remember is note 5. And then the third part of the question is going to ask us to prepare the correct income statement for the year. So it's a whole long question out of quite a number of marks. We need to do all of these things, and we need to take the step-by-step adjustments and record them where they are supposed to go. So let's have a look at the information and see what we're required to do. So we've been given here an income statement an income statement that is incorrect. And if you look down here, you should be able to see that there might have been some items that should not have been here. For instance, the purchase of office equipment. But we will talk about that just now. There are items that shouldn't be in here. They've told us to refer to the various notes 2.2 and 2.1 to see they're going to give us further information about these. They've also given us some balances on the balance sheet. So there's vehicles, equipment, and so on. And here is the first adjustment. So the first adjustment tells us that the sale of equipment amount. In other words, if I look up here, there's an item here called sale of equipment. So this amount here of 3,000 Rand. They've told us to refer to 2.1, which is our first information piece of information. It tells us that the sale of equipment amount, let's just write 3,000 over here, because I've just looked up what that amount was. They've said that this sale of equipment amount in the income statement is the cash received from an employee who purchased some old furniture that were replaced. So what happened is we sold an employee some furniture, and what they've done is they've recorded that as sale of equipment, but they have recorded the cash that we have received. They've recorded the physical money that this employee paid us. He paid us 3,000 Rand for these things. But it tells us that actually the cost of these items was 5,500 Rand, and the carrying value was 2,125 Rand. You need to be able to think about the mistake that the bookkeeper has made in this. They have recorded that we have earned income in the income statement of 3,000 Rand for sale of equipment. But there's something wrong here. We should not have recorded that. Look at the transaction again and see if you can work out what the bookkeeper has done wrong. Why should we not record 3,000 Rand in our income statement as sale of equipment? This is wrong. The reason is because your income statement should show only the incomes and the expenses that are in your business in that financial year. So we never show the cash amount that we've received for equipment. No. We don't show the cash that we've received. What we are supposed to show is the profit or the loss that we have made on the equipment. So this is the selling price. We've sold something for 3,000 Rand. But we want to show not the sale of equipment, we want to show the profit or the loss on the sale of equipment. So what we're actually going to do, we're going to fix this question by drawing up the asset disposal account. And if you remember, our very first instruction was to post to the asset disposal account in the general ledger. Here's where you now have to think back to your other section on fixed assets so that you're sure you know what's going on when you do an asset disposal account. And there are a number of steps in the asset disposal account which I'm sure you can remember, but we're going to do them together by posting to the asset disposal account in the ledger. So let's get to our answer sheet. Here's our answer sheet, the asset disposal account in the general ledger. I'll do some quick revision on this. The very first thing that you have to do is you have to record the cost price of your equipment that you sold or your vehicle that you've sold. You record the cost price on the debit side. So over here, we need to record the cost price of the asset that was disposed of. If we go back, we've got our information here, and it tells us that the cost price of these items, in other words, this furniture, was 5,500 Rand. This here is the cost price of the equipment that the person has bought from us. So if we go back to our T account, we need to record the cost price of 5,500 Rand over here. That's the first step. We also need to record some dates and some other information. So in the details column, we have to record what it was that we sold. Remember, what we sold was equipment. So I'm going to record equipment here. Some of you might think, but furniture isn't equipment. Just remember that for accounting terms, equipment can be all machinery in a business, like computer appliances or machines that manufacture goods or something like that. But it's also all furniture, all fittings, like light fittings count as equipment. So remember, if they tell you that you sold furniture, you should record it as equipment. So we need to record the date on which we sold the equipment over there. So let's just look back at the information that we've got. It told us that we sold this item on the 28th of February 2013. So in other words, the end of the financial year. Let's go back and just record so that our asset disposal account is correct. We're just going to record here that this happened on February the 28th. So that was your first step in asset disposal. Remember, you record the cost price of the item that you've sold, that you record on the debit side. The second step that you need to follow is that you have to record the accumulated depreciation on that item on the credit side. So over here, we need to record the accumulated depreciation. I'm going to write that in so long. So there's going to be accumulated depreciation. Notice that I'm writing the whole thing out. Remember that you are not allowed to abbreviate accumulated depreciation on equipment or on vehicles. Make sure you don't abbreviate it because you're not allowed to do that. Rather go onto a second line if you can't fit it all in. This also happened on February the 28th because you always record asset disposal on the day in which it happened. But now we have to put the accumulated depreciation in. So let's look back at the information that we've been given. And you should be able to see that nowhere, if you read this again, nowhere in this paragraph does it mention the words accumulated depreciation. Instead, what it does is it gives us something called the carrying value. So think back and see if you can remember. How do we calculate carrying value of an asset? I'm sure the formula is on the tip of your tongue. I'll write it down for you. The formula is the cost price minus the accumulated depreciation. That equals my carrying value. But now in this example, we've got the cost price. Here it is, 5,500. We've recorded it already. We don't have the accumulated depreciation. We don't know what it is, so I'm going to put an X in there because this is one of those questions where you have to work backwards to find a missing number. And then we've got that this sum is equal to our carrying value of 2,125. So now we should be able to work out what the accumulated depreciation is. We just solved this for X, so we need to take the X over to that side so that it becomes positive. We need to take the 2,125 over to this side. So what would happen is that 5,500 minus the 2,125 is going to give my accumulated depreciation of X. So let's do that on the calculator to make sure we don't get it wrong. I'm going to take my 5,500 Rand. I'm going to subtract the 2,125 carrying value, and that answer gives me the 3,375. That mindset is my accumulated depreciation, 3,375, and that is the figure that I have to record over here in my asset disposal account as my accumulated depreciation, 3,375 Rand. So that's the second step in preparing the asset disposal account. Our third step is that we record the selling price on the credit side. Now, you can dispose of assets in many different ways. You can dispose of them for cash, you can dispose of them for credit, you can trade them in, and the details that you're going to write here on the on the right-hand side are going to be based on what you're selling it for. So if you sell it for cash, you're going to receive the money in the bank. If you sell it on credit, you're going to receive the money only later, so you're going to write debtors control in that column. So we need to look here and find out how we are selling this asset. And if you look at the information, it tells us that it was cash received. Here it tells us cash received from an employee. Circle it in a different color. So if I received cash for sale of equipment, that obviously means that the employee must have paid me that money in cash. That's this 3,000 Rand that he paid us, that the inexperienced bookkeeper recorded as sale of equipment. She should instead have recorded the profit or the loss. So this 3,000 Rand is the selling price, and we've received it in cash, so we just have to record it in our asset disposal account, and that's actually pretty easy. All we're going to do is we're going to record bank over here, and we're going to record in my ledger 3,000 Rand. So now we have the final step in our asset disposal, and the final step is to calculate the profit or the loss on the sale of the asset. And the way we do that is we balance out this account. We balance out the asset disposal account. So on the left-hand side, we've got 5,500 Rand. On the right-hand side, it looks as if this side is bigger because we've got 3,000 and something plus another 3,000. It looks as if this is over 6,000 Rand. So what we need to do is take the bigger side, which is this 3,375 accumulated depreciation on equipment. It's still in my calculator. I'm going to add to that the amount that I've received in the bank, which is 3,000 Rand, and I'm going to get a total of 6,375. So this 6,375 is the total on the credit side. That's clearly bigger than the 5,500 that I have on the debit side here. So I will balance the account out by writing 6,375 here as well, and work out the balancing figure here. The way I work out the balancing figure, I will just do it on the calculator. So it will be 6,375, which is still in my calculator, minus the 5,500. That gives me the balancing figure of 875 Rand, which I'm going to write in over here, 875 Rand. What you now need to remember is that it's either a profit or a loss depending on which side of the asset disposal it is. So if it is on the debit side of asset disposal, it is a profit. And if it is on the credit side of asset disposal, it is a loss. Our balancing figure is on the debit side of asset disposal, so that is going to be what we call a profit on sale or profit on disposal of asset. I'm preferring to write sale because it's a bit shorter, I can fit it in more easily. Can you see we've now calculated a profit on the sale of the asset for 875 Rand. Our asset disposal account is balanced out because the debit side equals the credit side, so we've actually finished this part of the question and we can move on. But just remember that we've calculated a profit on the sale of assets of 875 so that we don't forget it. We're going to come back to it later when we do the income statement. I'm going to go back over here to where I had the information, and instead of the sale of equipment, this should have been the profit and loss of 875. It was a profit on the sale of equipment. I'm just going to record it here so that we can remember that when we do our income statement, we're going to record a profit on the sale of 875 here instead of the 3,000 Rand cash that the inexperienced bookkeeper mistakenly recorded. Okay, our second part, or our second adjustment says that there were new desks and chairs. New desks and chairs. What did we say earlier about desks and chairs and any type of furniture? You should remember that desks and chairs and any other type of furniture is considered equipment. So just remember that we're dealing with equipment over here. These desks and chairs were purchased on the 1st of December 2012, and the cost of these items was included in the income statement. This amount is also included in the equipment balance above. When you see that you've got equipment in the income statement, you should see some alarm bells ringing in your head because you should realize that there's a mistake that's going on here somewhere. Think back to grade 10 and grade 9 when you classified accounts into various ways. You should remember that equipment is an asset, and assets do not go in the income statement. Remember, in the notes that we discussed previously, we said that an income statement here includes only incomes and expenses. Assets actually are part of the balance sheet. So these extra chairs and desks that we've bought actually have no place in our income statement. They are not expenses, they are assets. Remember the difference between an asset and an expense. An asset is something that has value and can be used again and again and again. It's usually something that you buy for the long term in order to generate profits for your business. So if we've bought furniture, surely we're not expecting that furniture to be used up straight away. These new desks and chairs are going to last us a long time and we're going to make profits out of them. So they should not be in the income statement. In fact, they should be in the balance sheet. So let us now go to the second part of the question, which actually asks us to complete our fixed asset note. And let's see if we can record the information that we need here. This business, here's the fixed asset note, by the way. this business has only two fixed assets. It's got vehicles and it's got equipment. And there's a whole empty set of columns here and rows where we have to fill in the balances that we have. So let us look at what the question has given us and see what we can do about completing this fixed asset note. So if you look back here, we are looking at specifically the extracts from the balance sheet, because this is note number 3 to the balance sheet, not note number 3 to the income statement. So we're looking at these pieces of information: vehicles, equipment, and the accumulated depreciation. Here they've given us the amounts for accumulated depreciation on vehicles and the amounts for accumulated depreciation on equipment, and you can see that they've given us dates there. The 1st of March 2012. That is the beginning of our financial year. So the accumulated depreciation are the figures that they've given us at the beginning of the financial year. That is normally the case. They normally give you your accumulated depreciation numbers at the beginning, because in a pre-adjustment trial balance you still have to adjust for depreciation. So I'm going to take these two figures, the 79,200 on vehicles and the 22,200 on equipment, and I'm going to just fill them in to my note number 3. This is my accumulated depreciation on the 1st of March. In other words, it's the accumulated depreciation at the beginning of the year, not the accumulated depreciation at the end. We will still have to calculate that. So for vehicles, the figure was 79,200 Rand. Let's record it. 79,200 Rand. I've done something wrong here. See if you can tell me what it is, but I'll fix it in a moment. And the figure for equipment was 22,200 Rand. That's the accumulated depreciation, 22200, and I'm going to fill in that figure over here. What have I done wrong? I hope you spotted what I've done wrong. These two numbers need to be in brackets, okay? Remember, these are the figures relating to our accumulated depreciation. Depreciation reduces the value of our assets. It's a negative asset, so as such, in note number 3, these two figures are always shown in brackets. And here's a little hint for you. If you look down at the structure of this note, any figure that's got a word starting with D, so here depreciation, disposal, depreciation, depreciation, all of those figures, when you fill them in, they must all be negative. So that's the way you can remember it. If there is a word in your description that starts with the letter D, that figure needs to be negative. You will lose the marks if you do not show your accumulated depreciation in brackets. Now we need to look and find the cost price on the 1st of March 2012. We need to find the cost price for vehicles as well as the cost price for equipment. So if we go back here, we will see that we've got cost price for vehicles over here and the cost price for equipment over here. 176,500 for vehicles, 67,800 for equipment. But they are telling us that those are the balances on the 28th of February 2013. So we're not sure whether they are the figures at the end of the year or at the beginning. They haven't nicely put in brackets like here the dates on which these balances appeared. So we have to read a little bit further, and if we read further, it tells us that the new desks and chairs that we bought, this amount is included in the equipment balance above. So the amount of the desks and chairs that were purchased is included in the equipment balance above. So we bought them during the year, so that means we didn't have them at the beginning of the year. So if we look back at this incorrect income statement that the inexperienced bookkeeper prepared, here is our purchase of office equipment. This 7,600 Rand was purchased during the year, and they're telling us that it is included in this balance of 67,800. So we can't just simply take the 67,800 and put it in as the opening balance, because the question tells us that there was 7,600 Rand that was actually included in there that should not have been included, because we didn't have that at the beginning of the year. So if we want to calculate our balance on equipment at the beginning of the year, we're going to take the figure of 67,800, which we have in our trial balance, but we're going to subtract the 7,600, because that 7,600 was not included or should not have been included in our opening balance because we only purchased that office equipment during the year. So in fact, we only have 60,200 rands worth of equipment at the beginning of the year. So I'm going to fill that in as my opening balance for equipment. That figure is 60,200 rand, because remember, we shouldn't include the additional equipment that we bought during the year. That's going to be shown here as an addition for this financial year. Okay, vehicles is a bit easier because they didn't tell us anything about the vehicles. So we can assume that this is the figure that we had at the beginning of the financial year. They didn't tell us anything happened. There were no changes in our vehicles. Nothing extra was bought and nothing extra was sold. So this 176,500, I'm simply going to rewrite in here 176,500 rand. Now we need to calculate the carrying value. That's pretty easy if you know how to do it. All it is the cost price minus the accumulated depreciation. So we can do that for both of our columns. If we do it for equipment, we're going to take the 60,200 minus the 22,200 of accumulated depreciation. That gives me an answer of 38,000 rand. So my carrying value for equipment is 38,000 rand. And for vehicles, I'll use exactly the same method. I'll take the 176,500 and subtract the 79,200, and the answer comes to 97,300. That 97,300 is my carrying value for vehicles at the beginning of the year. Now we have to look at their movements, and the movements are our additions, our disposals, and our depreciation. We know that when we read the question, there were only items affecting equipment. There was never anything affecting vehicles. So we can put in here 2 dashes to show that the additions and the disposals for vehicles were nothing. We didn't actually change anything in our vehicles. However, there were some changes in equipment. So if we look back here, we remember that we disposed of equipment here. This was the sale of equipment that we did in the previous question. And when you're recording disposals, you always record disposals at the carrying value. So in note 3, you show disposals at carrying value. Here it is underlined for you, disposals at carrying value. We are lucky that in this question, there's nothing to calculate because they told us that the carrying value of the equipment that we sold was 2,125 rand. So all that we're going to do is next to our disposals for equipment, we're going to put the 2125, and because we've sold it, it needs to be in brackets. Remember, here's another word that starts with D. The D indicates that something is negative. Then additions at cost has to deal with the extra equipment that we bought during the year. And that extra equipment that we bought during the year was the purchase of 7,600, which was not yet included in this amount of 67,800. So all we're going to do is we're going to go back here and record 7,600 rand as our additions at cost. So now we've done those 2 movements. One more thing that needs to be done, which is calculating our depreciation. So to calculate our depreciation, we need to know what the rate of depreciation was. And they've told us this here. They've told us that here's 2.3 and 2.4. Equipment is depreciated at 15% per annum on the diminishing balance method, whereas vehicles are depreciated at 15% on cost. To calculate the vehicles is easier because the cost price is easier than the diminishing balance method. So what we need to do, let's remember that it's 15% on cost. To calculate this year's depreciation on our vehicles, there were no changes. So that makes it pretty easy to calculate the depreciation. All we're going to do is take the cost price, which we have is 176,500. So the depreciation on vehicles, let's write it down here, is going to be the cost price times by 15%. Cost price times 15 over 100. We don't need to deal with any additional things purchased or anything that was sold. Just going to work out a straight 15% of the 176,500. And if I punch that into my calculator, I need the cost price of 176,500 times by 15%, And if I punch that into my calculator, I'll take the 176,500 and I must multiply that by 15%, and the answer comes to 26475. Let's record that over here, 26475. This figure for 26475 is my depreciation on vehicles, and that I'm going to record here as 26475. Remember that that is a negative number because it shows by how much our vehicles are depreciating. We also need to calculate for our equipment. We also need to do a calculation. So we need to do a calculation on the old equipment that we had together with the additional equipment that we've purchased. So we purchased additional equipment of 7,600 Rand. So what we need to do is we need to do two separate calculations. So I'll do it in a different color here. Depreciation on equipment. To calculate the depreciation on equipment, we need to take our old equipment and we need to take our new equipment. The new equipment is always easier because it doesn't matter whether the equipment, well, if you're doing the new equipment, you don't need to consider whether it's diminishing balance or cost price because the equipment is new anyway and hasn't depreciated yet. So our new equipment was this 7,600. So our calculation is going to be 7,600 and it hasn't depreciated yet. So if we had to subtract any accumulated depreciation, we'd subtract nothing because remember, the depreciation is calculated on the diminishing balance method for equipment. If you look back here, you will see that the calculation is done on 15% on the diminishing balance method. So if we have to calculate our depreciation on this piece of equipment, we also need to know when it was purchased. It was purchased on the 1st of December 2012 and our financial year ends on the 28th of February. So we only had that new desk and chair, or all those new desks and chairs, for December, January and February. We only had them for 3 months. So we had them for 3 months in this financial year, and we know that the depreciation rate is 15%. Both of those pieces of information are given to us. So if we want to calculate the depreciation on this equipment, we're going to multiply it by 3 over 12 for the number of months, and we're going to multiply it by 15 over 100. So to calculate that depreciation, what we will do, let's enter it into our calculator, 7,600, I don't need to subtract 0 because it stays the same, multiplied by 3 months, multiplied by the depreciation rate of 15 over 100, and that's going to give me the depreciation on the new equipment, which is 285 Rand. Let's record that there. Okay. If we need to calculate the depreciation on the old equipment, what we're going to do is we're going to look at what we had at the beginning of the year, which is 60,200, and that had depreciated by 22,200, and that carrying value is 38,000. So we're working it out on the carrying value, so we can take this 38,000 and put that here, that's the carrying value, and we can multiply it by 15%, and remember your old equipment is always for the entire calendar year. The nice thing about this question is that we don't have to consider our sold equipment because we sold our equipment on the very last day of the financial year. Remember, we sold it on the 28th of February 2013. I'm not going to explain why we don't need to consider this because this lesson is not on asset disposal, but go back and make sure that you know why we're not going to do a separate calculation for sold if an asset is sold on the end of at the end of the financial year. So we can calculate this in its entirety here, 38,000 times 15%. If I get my calculator up, it's going to be 38,000 times 15%, and the answer that I want comes to 5,700. So if we want our total depreciation for the year, it's 5,700 plus the 285, which was from our from our new equipment. The total depreciation that we're going to write off is 5,985 Rand, and that is the figure that we're going to record in here, 5,985 Rand. So there are still some figures that we need to calculate, in other words, the carrying value and the cost and the accumulated depreciation at the end of the year. I'm sure you know how to do it, because I'm sure by now you've done so much asset disposal and fixed asset notes that you know very well how to complete this note. So I'm going to give you some time during a break to work out these figures, and when we come back after the break, you're going to check them and see if you got them right. So try those now while we go for a break. We'll see you just now. Welcome back, Mindsetters, to the grade 11 lesson on partnerships and financial statements. Before the break, we started doing the note to the balance sheet on tangible or fixed assets, and I left some numbers for you to calculate during the break. So here they are. You can take a look at them. They are on the screen. I filled them in. If you don't know how to calculate them, make sure you go back and revise your lessons on fixed assets, because I'm not going to go through how to work out these 6 numbers in orange, but I'm sure that you would have done this by now and be able to figure them out. So we finished now with our tangible asset note, which, remember, is a brand new note for grade 11. You didn't have this in grade 10. So it's important that you know how to complete this one. But now we're going to look at the main thrust of today's lesson, which is our income statement and the various sets of adjustments. So this question gave you an income statement that you needed to fill in, and they also gave you an income statement that was prepared by an inexperienced bookkeeper, which had information that was wrong. So there was a whole lot of information here that the inexperienced bookkeeper included in her income statement that we need to fix and we need to record correctly. So what we're going to do first, to answer the question on the income statement, the useful tip that you should start off with is go through your trial balance step by step and the figures that you've got in the trial balance, and record them one by one with an open bracket, one underneath the other, in the correct place where they're supposed to go in the income statement, and then we're going to make various adjustments afterwards. So our answer sheet, as you can see, is almost completely blank. They've only filled in 1 or 2 things in here. So what this means is that we're going to get marks for every number that we fill in if it is in the correct place. So you need to remember your format very well, and you need to know that it starts with sales, and then we have cost of sales. So if we go back to our trial balance, or to the incorrect income statement that the previous bookkeeper prepared, here is the sales figure of 323,320. I'm going to remember it, 323,320, and I'm going to record it over here in my opening bracket, 323,320. So I've recorded the incorrect balance to begin with, and we're going to make adjustments here, eventually closing the bracket like this and transferring the answer in there. This is very, very important, because the examiner is going to want to see your calculations, and you need to get into the habit of doing your calculations in brackets over here. So I'll show you how that works in a moment, but for now we're just recording our opening balances. We also have cost of sales as 192,000. So let's record that in here, 192,000. And notice that I'm also crossing them off on the incorrect income statement to show that I've used the number. Each number needs to be used once and only once, and we're going to put that information in where it should go. Gross profit we work out by taking sales minus cost of sales. We're going to work that out in our income statement, in our correct one. Then we've got a set of other income, and she has put in here, the inexperienced bookkeeper has put in rent, discount received, sale of equipment, and interest on fixed deposit. Have a look at that and think about what's wrong with it. Firstly, the rent income we know is in the right place. It counts as other income, so we should put in here rent income with an opening balance of 71,500 Rand. Our next item that we have is discount received, and that is also in the right place. The 2,420 should appear in the income statement as a discount received, and we've got an opening balance of 2,420. Remember, we might not adjust all of these numbers, but we need to show them here in case we need to perform a calculation on them. Once we've written this in, we actually don't need to refer back to the wrong income statement at all again. Okay? Then the next item here is our sale of equipment. And remember, this is the adjustment that we had to make. We know that this 3,000 Rand is wrong. We should never record just sale of equipment in our income statement. What we want instead is the profit or the loss on the sale of equipment. So remember, when we did our asset disposal account over here, we calculated that we made a profit on the sale of the asset of 875 Rand. That is the figure that must go into our income statement, not the 3,000 Rand here that we've received. So we're going to fix the first error that we've encountered, and the way we do it is, instead of recording the 3,000, we're going to just put in here profit on disposal of asset, or profit on sale of asset, and we're going to put the figure of 875 in here. I don't think that we're going to change that number because we've already calculated our profit, but just in case there is going to be some other adjustment, I'm just opening the bracket anyway. And then finally, the inexperienced bookkeeper has put interest on fixed deposit here in this section. What we need to realize is that there is a very special place for interest in our income statement. So interest actually goes right at the bottom here. It's got its own special place. So if you remember, let's fill in the missing figures that we don't have, or the missing words that we don't have. We start with sales, subtract cost of sales, and get gross profit. Then we add our other income, which I'm going to list here. That gives us gross income. Then we subtract our operating expenses, and the answer sheet has got a box here. You see this is slightly thicker. It's got a box, so we know that we're going to have operating expenses all the way down to the end of the box. So all of these lines should be full of operating expenses. So that means that once we've taken the operating expenses into account, our next line should be operating profit, which we're going to get to shortly. And then after operating profit, there are a whole lot of lines left blank, and you need to know that after operating profit, we actually are going to have interest income. Remember, it's shown as a separate item because interest income is important to the business. We want to know how much money we're earning from our investments, so we put it there. Then we get another subtotal, which is called net profit or operating profit before interest expense. This is followed by interest expense, and only then do we finally get our net profit for the year, which appears here. So the bookkeeper has made a mistake in the income statement that she has drawn up because she put her interest on fixed deposit in the wrong place. This 3,110 should not be included in other income. This should be moved to interest income. So I'm going to take the 3,110 Rand and I'm going to put it here, open a bracket, and put 3,110 Rand as interest income. Okay, so that's what the bookkeeper has done wrong with the income section. Let's now look and see if we can figure out what she's done wrong with the expenses section. The expenses section starts off with debtors allowances. Now, I'm sure you remember that the very first thing you do in any income statement is you subtract debtors allowances from sales. So this 3,320 Rand should not have been recorded as as an operating expense. This 3,320 Rand needs to have been subtracted from sales over here, because debtors allowances represent returns by debtors, and as such they are subtracted from sales. So make sure you know how to do that. Then we've got various other pieces of information. There are salaries and wages of 56,000, total employers' contributions, stationery. Let's just check all of these and see which of these are not expenses. You can see salaries and wages is an expense, employers' contributions is an expense, stationery is an expense, so is consumable stores, so is insurance, so is telephone. The purchase of office equipment is not one, and that's the one which we had to take out. Remember, we recorded it in a completely different place because equipment is not supposed to go in your income statement, so we're going to leave that one out. Remember, the income statement is only for incomes and expenses. Bank charges, we know, is an expense, so are bad debts, and now here she's made another mistake. This provision for bad debts goes in a very special place. Think about where that one goes. We're going to come back just now, but please bear in mind that this is not an expense, and we'll talk about it shortly. Here's our interest expense, and what we should do is should record the interest expense on overdraft. The amount was it was 970. That amount shouldn't be recorded in operating expenses. It should be recorded over here as its own special item. 970 Rand should appear here. And then finally, we've got sundry expenses of 22,460, and that is also an expense and needs to be recorded with an opening balance. So I'm going to just take a moment to record all of these expenses where they need to go. So I've transferred all of our expenses in here, but you can see that there are still 3 lines that are open. So usually when there's some lines open, that means that there are some extra expenses that need to go in there. And one very important one is that we have to include depreciation. Remember, depreciation is an expense to the business, and as such, that's got to be recorded in our expenses section. So fortunately, we've worked depreciation out already. Our depreciation was worked out here in our fixed asset note. There was depreciation on equipment of 26475, and there was depreciation on vehicles of 5985. Remember, these two figures together are your total depreciation for the year, and as such, we have to record them in the income statement as depreciation. So if I want to work out my total depreciation, I'm going to take my figure of 26475. To that, I'm going to add my depreciation on equipment of 5985, and that gives me my total depreciation for the year of 32460. That figure I'm just going to take and write in my income statement, 32460. I'm going to show here as the depreciation for the year, 32460. There are still 2 spaces left here, but we're going to fill them just now when it comes to doing the various adjustments. Okay, now there's still another note that this question wanted us to do. If you look back here, they also wanted us to do the note on trade and other receivables. Remember, that note on trade and other receivables is the note that shows money that you are expecting to get in the future. And its format is very important to learn, so you should hopefully remember that it starts with trade debtors, and then the figure that I spoke to you about earlier, the provision for bad debts. So that is the figure that we think we are going to have to write off in the future, because we know from experience that not all our debtors are going to pay us. So what our inexperienced bookkeeper did is she recorded this figure of provision for bad debts of 1170. I asked you earlier to think about where we have to record it. I hope you got the answer that it has to go in note 5 because it is not an expense. So this figure of 1170 we need to put in note 5, and it needs to appear here in brackets. We're going to adjust it later on, but please remember that the provision for bad debts has to be shown in brackets because it's going to get subtracted from our trade debtors to get the figure that we call net debtors. So trade debtors minus your provision for bad debts equals your net debtors. Those are usually your first 3 items in the trade and other receivables note. Please remember that we also have in here accrued income, and we also can have prepaid expenses. I hope you're learning from this exercise how important it is to know what goes where, because otherwise your income statement is going to look like the income statement of this inexperienced bookkeeper, and you're going to make lots of mistakes and lose lots of marks. So make sure you learn this very, very well. I've now recorded all of my expenses and all of my incomes. I really don't need to look at this at this incorrect income statement again. So now I can move on to the various adjustments. We did 2.1 and 2.2 already, and we did 2.3 in calculating the depreciation, as well as 2.4 for vehicles. Now we have to look at the adjustments that our inexperienced bookkeeper has not taken into account. So the first one is 3.1 tells us that the rent for February 2013 was not yet received. So somebody has been living in the property belonging to the business, but he or she has not paid us rent yet for February 2013. What that means is that this figure in my income statement for rent, which I've got as 71,500, is wrong because it does not include the rent for February 2013. So what you should be able to see is that this 71,500 Rand is actually 11 months rent, because it's not including the rent that we should have received for February. So what we need to do, we actually need to calculate what 12 months rent would be. So the way we would do that, let's just get some space here. To calculate the rent, we're going to take the figure that we have, which is 71,500. But that rent is 11 months rent, so we're going to divide it by 11 to work out what 1 month's rent is. So if we get our calculator on the screen, 71,500 Rand is the rent that we've received. I'm going to divide it by 11, which tells me that the monthly rental is 6,500 Rand. So now my adjustment becomes easy. We are short 1 month's rent in our income statement, so all we have to do is we have to go up here and make the adjustment and add to the rent amount that I've got 6,500 Rand, so that it reflects in the end 12 months rent, because we have to record the rent that we should have received. Regardless of whether we've got it or not, we need to put in the rent that we think we should have received based on the fact that somebody has been living in that building for 12 months. So we've got to add 6,500 Rand to rent income. At the same time, that is income that we have not yet received, so it's still owing to us. That is income that is receivable, it must still come to us. So that means that it's got to be recorded on the opposite side in our note on trade and other receivables. That is an accrued income for rent of 6,500 Rand. So let me put it in brackets here, because that is what we still have to receive for rent. Let's look at the second adjustment. Second adjustment in the section says that insurance includes monthly payments up to the 30th of April 2013. They love asking this insurance question. You will see it a lot. And if you know what happens, it's really very, very easy. So my suggested way of answering the question is to draw up a timeline to calculate the insurance adjustment. So we need to draw our timeline for our financial year. And we've been told here that our financial year ends on the 28th of February 2013. So if it ended on the 28th of February 2013, that means it must have started on the 1st of March 2012. So this is our timeline. The green represents our financial year. Now, we look at our adjustment, and the adjustment tells us that the insurance number that we've paid includes monthly payments up to the 30th of April 2013, which is outside our financial year. So if I have to do that, if I look at this timeline, I've paid up to the 28th of February, but I've in addition paid some extra up to the 30th of April 2013. So I've actually paid more than I was supposed to in this financial year. So if the financial year ends on the 28th of February, I have prepaid my insurance for March, and I've prepaid my insurance for April, so I've prepaid my insurance for 2 months that are not in this financial year. So the figure that I have will actually be for the 12 months that are in this financial year, plus the 2 months prepaid. But we don't want to include these 2 months prepaid, because they are for the next financial year. They are actually prepaid expenses. So what we need to do is we need to look at our insurance figure, which is over here as 3,920 Rand, and we're going to divide that figure by 14, because that represents 14 months of insurance. That's going to give me 1 month's insurance, and I'm then able to adjust the figures so that they show the right answers. So if I do it on the calculator, I'm going to see 3,920 Rand. That's my total insurance, but that was 14 months, so I divide by 14. That means that 1 month's insurance was 280 Rand. But I have prepaid my insurance for 2 months. So what I have to do, my prepaid expense is going to be 280 times 2. So if I'm calculating my prepaid expense, I'll take this figure, multiply it by 2, and the answer comes to 560 Rand. It's 560 Rand that was prepaid for the next financial year. So to complete the adjustment is pretty easy. We're going to subtract that 560 from the insurance figure that I have. So I'll go to the insurance figure here of 3,920 and subtract 560 so that it reflects only 12 months of insurance and not the 2 months that we've prepaid. And then I'm going to go to my note on trade and other receivables, because you should remember that prepaid insurance is a receivable, and my prepaid expense is going to be 560 Rand to begin with. That is insurance that I've prepaid, or I've paid it in advance for the next financial year. So that's the end of that adjustment. We've had one accrued income and one prepaid expense. Please note, mind sellers, that when you're doing adjustments like this, you sometimes do the income statement and the balance sheet together. So don't think that you have to first finish the whole income statement before you can move on to the balance sheet. The adjustment is split between two parts. One half is usually in the income statement, and the other half is usually in the balance sheet. Let's now look at our next adjustment, which is adjustment 3.3. I'm sure that this one is very familiar to you. It tells you that we've done a physical stock take, and it's shown me a physical count of stock. It tells me that trading stock was 25,640, and that I've got unused consumable stores in stock amounting to 2150. This should ring alarm bells in your head to tell you that you are calculating either a trading stock deficit or a trading stock surplus, and that we're dealing with consumable stores on hand. I'm sure you know how to do this because you've seen this adjustment many times before. But if I look at my trading stock is 25,640. What you now need to do is you need to compare this to the number in the balance sheet. So if we go up to the balance sheet, we will see that the number in the balance sheet for trading stock was 27550. So let's write that down here so we can compare the two numbers. The balance sheet figure was 27550. That is the trading stock that we think we have. But when we counted it, we saw that there was trading stock of 25,640. So there is some or other discrepancy between these two. What we think we had is much more than what we actually have when we count it. So we actually have a trading stock deficit because the amount in the trial balance is much more than the amount that we've actually counted. So we need to calculate that trading stock deficit, and the way we do it is we just subtract the one number from the other number. So the amount in our trial balance was 27,550 Rand, and we're going to subtract the amount that we've counted, which is 25,640, so that gives me a deficit of 1,910 Rand. So if we go to our income statement, we see that there's space for our deficit over here under depreciation. I'm going to call it a trading stock deficit. And the answer that we had, we calculated it as 1,910 Rand. Sorry, it was on the calculator here. 1,910 Rand. It's always good to put this calculation on the calculator. It's good to rewrite that calculation in the balance sheet. Because, sorry, in the income statement, because you can actually get marks for it if you calculate the trading stock deficit incorrectly. So if I were you, I would just copy this calculation down, 27550 minus 25640, and that gives me the answer. My trading stock deficit is 1,910 Rand. Please just go over what would have happened if it was a surplus. In other words, if the amount that we've counted was more than the amount in the books, then we would have had a trading stock surplus somewhere up here in our other income. So just make sure you know how to do that in preparation for exams. When we're doing the consumable stores adjustment, it tells us that unused consumable stores amounted to 2,150. These items are called consumable stores on hand. And the way we do the adjustment, we simply go to our income statement and subtract the 2,150 from the figure that we have for consumable stores. So that was here 7,350. To do the adjustment, we subtract the 2,150, which was on hand, we subtract from our consumable stores to calculate the number that we've used. So in other words, what this shows you is that you started with consumable stores of 7,350. That's what you spent on them. And out of that, there was 2,150 that were left over at the end of the year. So we actually only used the difference between the two, which we can calculate and put in the income statement. We will take the 7,350, which we bought. We will subtract the 2,150, which was on hand, and that gives us 5,200 Rands worth of consumable stores were actually used, because that 2150 is left over, we can reuse them again next year. If we now look at our next adjustment, our next adjustment is this item here. It tells us that the salary of a clerk on leave was not yet entered. Her net salary is 4,460. Her total deductions add up to 2,340, and what it tells us is that the employer's contributions were taken into account. What you need to remember is that this is the salary of a person who is on leave. We haven't entered this at all. So we have to record this in the way we normally would. And what they're testing here is that you know that in the income statement, we do not record just the net salary. In fact, in the income statement, we record the gross salary. And once you know that, the adjustment is very easy. So we need to calculate the gross salary, and you should remember that the gross salary is a concept from grade 10. If you take your net salary and you add all your deductions, what then happens is you get your gross salary, and the gross salary is the amount that should be shown in the income statement under salaries and wages. So it's quite easy if we know how to do the calculation. We have to go to our income statement, and in there we have to record the 4,460, which was the net salary, and to that we just have to add the 2,340. So that shows us that the gross salary for this particular worker was 6,800 Rand, and because that was not recorded, we have to go back to our income statement and we have to add the figure 6,800 to our salaries and wages. So the amount of 6,800 was not recorded because salaries and wages always show the gross amount, not the net amount. They told us that the employer's contributions were correctly recorded or taken into account. Here it tells you that. I'll show you. It says that the employer's contributions were taken into account. So we don't need to do anything with those employer's contributions because they've already been recorded. If we had another note, in other words, the note on trade and other payables, we would have to record in there that we still owe this employee that money. So the contra entry would be in our trade and other payables, we owe the salaries, we'd have creditors for salaries for these amounts. But you don't have to worry about that because this question is only asking us to do the note on trade and other receivables. So this is not something that we still have to receive, it is something that we still have to pay. So as such, we're going to record that in trade and other payables, and we can leave that one out. Now we've got adjustment 3.5. And adjustment 3.5 tells us that the telephone account for February 2013 of 480 Rand was paid on the 5th of March. So what that means is that this is an amount, we used the phone in February, we made phone calls, and the total came to 480 Rand. But we only paid this on the 5th of March. So in February, the amount that shows in our income statement of 6,410 Rand for telephone does not include the 480 for February, which we only paid in the next month, which the inexperienced bookkeeper forgot to add. So all we have to do here is we have to add 480 Rand to telephone as an accrued expense that must still be paid in the next financial year. But this 480 also needs to be shown as accrued expenses in the note on trade and other payables. Once again, I'll remind you, we were only being asked in this question to do the income statement and the note on trade and other receivables. So we're not going to do anything with that particular adjustment here. All we're going to do is add it to our telephone bill as we were supposed to add it. Let's now look at our next adjustment, which is the adjustment on depreciation, and it says that depreciation was not taken into account, refer to point 2 above. The good news is that if we look at our income statement, we have already taken into account our depreciation. It was in point 2 above. This red figure here that we put in earlier, this 32460, doesn't matter that we haven't taken it into account beforehand, but we sort of thought ahead and put it into the income statement as it should have been. So the 32460 should just have been recorded. We've done it already, so we don't need to do anything else, and we can tick that one off as well. Okay, now 3.7 is the provision for bad debts. It says that the business makes provision for bad debts at 5% of trade debtors. And what they did here is it says the bookkeeper calculated 5% of the debtors control balance and she used this amount in the income statement. So what the bookkeeper did was wrong. We need to just make sure that we calculate the correct provision for bad debts. I'm sure you know how to do a provision for bad debts, but we'll work through this one slowly together so that you understand what exactly should be done. So you're going to go to your debtors control account and you're going to see here in trade and other receivables that we have a provision for bad debts of 1170. Here it is, 1170. We need to check whether that figure is correct. So what we're going to do is we're going to go to our balance sheet and we're going to find our debtors control, and we don't know what this debtors control amount is. There is a question mark over here. But what they do tell us is that the provision for bad debts was calculated at 5% of the debtors control balance, and they used this 5% in the income statement. So what she did, she calculated the debtors control balance and she used the amount that she calculated in the income statement. So remember, we had a provision for bad debts over here which we took out, this 1170. That is the number that she used, and we've been told that that is 5% of our debtors, so we've been told that that figure is correct. So if we go back here to our note on trade and other receivables, that is the figure that we should have. This 1170 should appear here, and we've been told that this is 5% of debtors. So this figure here is 5% of the debtors control number at the top, and that is the figure that we have to calculate. Remember, we can't just put it in because we've been given, when we looked for our debtors control, where we expected it to be, there was this question mark. So what you now need to think about is to calculate this question mark. We realize that we've got a figure of 1170 that is 5% of trade debtors. So if you like, you can use the want over have formula, but there's another way that we can do it. So to calculate debtors control, okay, we have the provision, and we know that the provision is equal to 5% of debtors control. I'll just abbreviate it as DC. So this provision here of 1170 is 5% of our trade debtors. So we know that 1170 is 5% of debtors control, and if we want to solve for debtors control, we can put an X in here. So we know that 1170 is equal to 5% of X. This X is the number that we want to calculate. An of is always multiply, and 5% is always over 100. So we know that 1170 is equal to 5% of X. So if we want to calculate X, all we do is we multiply both sides by 100. So then on this side it vanishes. And we divide both sides by 5. So if we take 5 and divide it by 5, it vanishes and becomes 1. And we have to divide this by 5, so we'll get 100 over 5, and that equals X. So to calculate our debtors control, we'll take our 1170, multiply it by 100 over 5, and that should give us our debtors control figure. Let's do it quickly. 1170 times by 100, divide by 5. We now know that our debtors control is 23,400 Rand. So let's write that over here. Our debtors control is 23,000. Our debtors control is 23,400 Rand. Let's just check the figure. And the way we can check the figure, we know that we're supposed to have 5% of it as our provision. So if we multiply this by 5 over 100, that should give us the correct figure of 1170, which it does. Now, there's another thing that we have to do in this particular question. This question gave us another piece of information that you may not have noticed, but it's here. It tells us that the provision for bad debts on the 1st of March, in other words, at the beginning of the financial year, it was 1,320. So that is last year's provision for bad debts. We have now changed the provision for bad debts so that it's not 1,320 anymore. our new provision for bad debts is 1,170. So we have adjusted or changed the provision. So what we've done is we've adjusted the provision from 1320 to 1170. What we've actually done is we've subtracted the difference between these two. The difference between 1170, which is our current provision, and 1320, which was last year's provision, comes to 150 Rand. We have subtracted 150 Rand from the provision for bad debts from last year. If we've subtracted 150 Rand, we've adjusted our provision. We have made actually a provision for bad debts adjustment. I'm just going to write provision adjustment here. We'll write it properly in the income statement of 150. So we've taken some money out of our provision for bad debts. What you need to remember is that this is an income to the business. And if you're not sure how to differentiate between an income and an expense, make sure you go back and understand how to do the provision for bad debts. But we've adjusted it by 150. We've reduced it from 1320 to 1170. So what we're going to have is over here, there's going to be a provision for bad debts adjustment of 150 Rand. And that is an income because we have decreased our provision. If we had increased our provision, we would have moved this provision for bad debts adjustment to our section on operating expenses. So make sure, mindsetters, that you know how to do that adjustment. It's an important one. It comes up time and time and time again. So that was actually our final adjustment. What we now need to do is just complete this income statement and balance sheet by calculating all of the missing numbers. So let's start now with our trade and other receivables. Very easy to calculate. We've now put all the figures in. All we have to do is make all of the adjustments. To calculate net debtors, all we're going to do is take the 23,400 minus the provision for bad debts, closing all brackets and writing all totals of all brackets in the column at the end is a good idea to start off with. Then we can just add everything up. So to complete this note, what we're going to do is start off with our trade debtors of 23,400 Rand. We're going to subtract our adjustment of 1170, and that gives me a little subtotal which I'm going to write here. Net debtors is 22,230. Then to calculate our total trade and other receivables, we have to add these three together: net debtors, accrued income, and prepaid expenses. So it's 22230 plus 6,500 plus 560, and that gives me my total debtors of 29,290. That is the total answer for trade and other receivables and would be written on the balance sheet if you were doing a full balance sheet. All we still have to do now to finish the question is to go to our income statement, which is partially completed here. We need to calculate all of the numbers that have got brackets in. Some of them, there were no changes, so I'll just do those first. So I'll put 2420 here, 875 goes here, and then most of our other expenses also didn't have any changes. We had 1,220 in bad debts, 2,800 in employers' contributions, and 5,330 in stationery, plus the figure that we already calculated of 32460 for depreciation. Then there are some others that we have to calculate, which is just the sum of everything in brackets. So let us just do that quickly. To take our sales figure, to calculate the figure that appears, we need to take our sales of 323320. Make sure you don't make mistakes and put too many threes or too few threes. From that, we're going to subtract 3320, which is my debtors allowances, gives me a total of 320,000. So my sales is 320,000. I have cost of sales of 192,000, which is in brackets. And then I need to calculate my gross profit. And the way I do that is I simply take sales minus cost of sales. So I'm going to subtract my 192,000 here. That gives me an answer of 128,000. Now I just need to add all the various numbers in brackets. So the 71,000 plus the 6,500 is going to give me my rent income, so let's do that quickly. So my rent income is going to be the 71,500 plus my 6,500, which was the adjustment. That comes to 78,000, which I'm going to write in here. And then remember, I need to add everything in this box to put the answer at the top as my other income. So I'll add the 78,000, which I've already got, plus my 2420, plus my 875, plus my 150, and that gives me my total operating income of 81,445, which I'll write here. Then you need to realize to calculate gross income, I have to add those two together, so plus 128,000 gives me my gross income of 209,445. And now we have to do the same with our various expenses. We just have 3 to calculate, so let's do those quickly. To calculate our insurance, we're going to take 3920 minus 560, which comes to 3360. Close the bracket and write it here. To calculate our telephone, we're going to take 6410 plus 480, which comes to 6890. And then to calculate our salaries and wages, we're going to take 56,000 plus 6,800, which gives me the total salaries and wages of 62,800. Now what we still have to do is we have to calculate the sum of all of these figures here. Everything in the box will give you our total operating expenses. Just to save some time, I'll just check to see if you added them all up correctly. Your answer should have been 148,990, which I'll write here, 148,990. And then just to finish off, how do we calculate our operating profit? To get that, we have to take this gross income minus my operating expenses. So let's do that quickly. Gross income of 209,445 minus operating expenses of 148,990, and that comes to 60455. So that means our operating profit is 60455. We then have to add our interest income of 3110. So I'll just close this bracket here. That's going to give us profit before interest expense. So add 3110 gives me an answer of 63565. And then I've got to subtract my interest expense of 970. Remember to put it in brackets, minus 970. And that gives me the final answer of my net profit for the year, which is 62595. 62595. So to end off Mindsetters, just to tell you, this type of adjustment is hard work. It takes quite long to do, but if you know how to do these adjustments, you should have no problems calculating your financial statements. Make sure you practice them regularly. Make sure you're well prepared by doing as many examples as you can get your hands on, so that when you get into that final exam, you are confident, you are accurate, and you are fast. I wish you good luck with those exams. We'll see you next time.